welcome back to JPX Energy Market Weekly Updates. As Russian troops intensify their attacks on major cities in Ukraine, European crude benchmark dated Brent broke above $120 per barrel. JPX Dubai future contract for May delivery also witnessed a new high of around 76,000 yen, or around $105 per barrel, marking the highest levels since 2008. Premiums for Brent spot crude hit historic highs of $18 per barrel over crude for delivery in 6 months. We could see a similar market structure in JPX Dubai contract. Spread between May and July contract once rose to 4,450 yen, or around $6 per barrel over last week. There's new concern that attack on nuclear plant, which provide more than a fifth of the Ukraine energy, could worsen Russian and Ukraine conflict and may result in tougher sanctions on Russia. Oil prices rebound after settling lower on March the 3rd on the increasing possibility of the Iran nuclear deal, but time spread of both JPX Dubai and IC Brent continues to fall. There's a potential risk of downward price adjustments if there's a sustained divergence between market structure and the price. Crude futures briefly jumps on Monday morning on the news the Biden administration is discussing with its European allies a potential ban on Russian oil imports. Besides, Libya production is reported to drop again. The market will continue to weigh on the impact of various news on the supply and demand outlook. Volatility will remain at a high level. On the crude physical market, international sections, which have largely focused on Russia's financial sector in the previous week, have been expanded to include its energy sector. On March the 2nd, the UK banned all Russian-owned oil tankers from docking in British ports, and earlier Canada blocked imports of Russian oil. Russia's Eurocrude was popular in Europe because of the short selling time to European refineries, which are often designed to run this relatively heavy and sole grade. But oil price differentials are reflecting European refineries' clear unwillingness to take Russian crude. Plus data shows that Northwest Europe Urals was assessed further lower on the day at a fresh record discount of more than $27 per barrel to dated Brent. From a quality standpoint, European Euro buyers have a number of alternatives to Russian grade. These include North Sea crudes such as Forties and Jones Sverdrup, with the latter having emerged as an important alternative to Urals in Northwest Europe since coming on stream in 2019. Buyers also occasionally turn to Iraq Basra crude streams when Euro supplies tighten or prices surge. These sour Middle East crudes are often blended with imports of US light sweet WTI to yield a synthetic Urals replacement. Demand for Basra crude is red hot, especially in Europe. However, in February, 2 oil fields were shut in, taking around 480,000 barrels per day of Basra supply offline. Iraq managed to hike Basra crude export by 150,000 barrels per day in February, but much of the additional volume came out of storage as production rising less sharply. Production constraints and term commitments means that Iraq has very little spare crude to offer. There's growing expectations that the United States and its allies would continue to apply pressure on Russia's energy market by a widening array of sanctions. Oil companies, refineries, shippers, and traders are all weighing their involvement and exposure to potential risks. Besides crude itself, one of the most significant fallout on sanctions on Russia is seen in the rise in tankers freight. Due to uncertainty over gas oil shipping from Russia, long-range or LR2 freight on Persia Gulf to Europe routes have almost doubled in just a week, over $3 million. Freight for crude tanker benchmark VLCC Middle East Gulf to China route was last assessed at world scale 55.36, representing a 41% gain. Because Basra light crude is the cheapest deliverable grade for China's Shanghai crude oil future contract, the FOB price of Basra light crude at the port of loading plus the applicable freight, insurance fee, and other expenses for a shipment to a Chinese port, and plus the applicable fees of port, dock, loading, and storage after arrival at the Chinese port should equal to the theoretical delivery price of a Middle East crude at a Chinese port. So the spread between JPX Dubai and IE's Shanghai crude may face downward pressure because of tightened Basra light crude oil stream and higher freight rate. Okay, that's all for this week. For more information, please stay tuned to the JPX Energy Market Weekly Updates.